70 record closing highs so far for the Dow.
Blasting through a ceiling.
In a record-setting IPO.
Investors who have been riding the wave.
When the stock market is booming, we're made to believe the economy is booming.
Today we will discuss about the impact of monetary policy on the stock market of Pakistan. My name is Ibrahim. Before heading towards our topic, I'll be starting off by giving you an overview of what monetary policy is and why it matters so much for investors and economists alike. Monetary policy refers to the actions taken by central banks like the Federal Reserve or the State Bank to control the money supply in the economy. The two main goals, keeping inflation stable and ensuring economic growth. They do this through tools like adjusting interest rates and buying or selling government bonds. Now, why does this matter for the stock market? Well, every move by the central bank sends signal to investors. High interest rates, for instance, tend to lower stocks prices by raising borrowing costs for businesses. Conversely, rate cuts usually boost stock markets by making borrowing cheaper. So, as we discuss this further, each of us will break down how these policies impact various aspects of the stock market. Let's move on to Abdul Razak, who will explore the specific role of interest rates in this dynamic.
Myself Syed Abdul Razak Sufi, and I will explain interest rates and stock market dynamics. Let's now dive into how interest rate, a key tool of monetary policy, directly affect the stock market. When central bank rise interest rate, they make borrowing more costly for companies. Higher rate mean increased expenses on loans, which often reduces profit and causes stock prices to fall. Consumer also feel the pinch as higher rate makes credit more expensive, leading to lower spending. All these factors put pressure on stock market. On the other hand, when rates are cut, borrowing becomes cheaper. Companies can expand more, and all the company tends to grow, all of which can lead to rising stock prices. So in a sense, rate changes are signal that the markets reacts to immediately as investors anticipate the effect on companies' earning and economic activity. Next, let's hand it over to Ali Afridi, who will discuss how this monetary policy shift impact different sectors within the stock market.
Myself, Ali Afridi, and I will explain sectoral impact of monetary policy. Now that we understand the basics of interest rates, let's look at how different sectors respond to monetary policy change. Not all the industry react the same way to rate adjustment. For example, technology companies often rely heavily on borrowing to fund innovation and growth, which make themselves sensitive to rate hikes. When rates increase, technology companies may face higher borrowing costs, which can slow down their growth and lower their stock prices. On the other hand, financial institutions like banks may benefit from higher rates as they can charge more interest on loans. This usually boosts their profit and stock prices. Similarly, sectors such as consumer staples or utilities tend to remain stable regardless of rate changes because their products are essentials. So understanding how sectors are impacted by monetary policy can help investors make smarter decisions based on the economy direction. Now let's turn to Jazim, who will cover some strategies to help investors negotiate these changes.
I am Jazim. I'll conclude our presentation by discussing strategies investors can use to respond to changes in monetary policy. When rates rise, defensive stocks like those in utilities or healthcare can be safer option because they provide stable earnings. High interest rate environments can also make bonds more attractive as they offer reliable returns. On the other hand, when rates are low, growth stocks, companies expected to grow faster than the market average, can be appealing because they can borrow cheaply to expand. Additionally, sectors like real estate often perform well when rates are low, as people are more into buy the properties due to low mortgage rate. The key is diversification and being informed. By spreading investment across various sectors and asset types, investors can reduce risk and stay resilient during both high and low interest rate periods. That's our analysis of how investors can navigate changes in monetary policy.